Welcome to this Talk Tickers Explainer, where we are diving deep into Mitsui Fudosan's absolutely blockbuster first quarter results for fiscal year 2025. So, let's get right into it. Okay, let's start with the headline number because, wow, it is a jaw-dropper. Mitsui Fudosan's earnings per share came in 106% above what analysts were expecting. Let's be really clear here. That's not just a small beat, that is more than double what the street thought was even possible.
And this wasn't just a beat on one metric. No, this was a record-setting quarter pretty much across the board. So let's break down those incredible headline numbers.
As you can see, it was just a clean sweep of record-breaking numbers. Revenue shot up over 27% year over year, which is great. But the real story here is profitability. Net income just exploded, jumping over 90%. I mean, this wasn't just a good quarter. It sets an incredibly high bar for the rest of their fiscal year.
You know, the funny thing is, the market didn't quite know what to do at first. The stock closed almost totally flat on the day the news came out. It actually took a full day for investors to really process it all, and then we saw that huge surge, nearly 6% on really heavy volume, as the sheer scale of this beat finally sank in.
So, the big question is, how on earth did they pull this off? Let's pop the hood and see what was really driving these numbers. It's a story that's part operational excellence and part brilliant strategic execution.
The primary engine, no surprise, was the properties sales segment. I mean, look at that. It contributed the lion's share of the profits. But this wasn't just business as usual. This segment was absolutely firing on all cylinders.
And here's the secret sauce for the quarter: an exceptional 36% operating profit margin in their sales to individuals. This was driven by handing over the keys to some ultra-premium properties, like Mita Garden Hills. Now, to put that in perspective, their own forecast for the entire year was a 25% margin. They completely blew past their own annual target in the very first quarter. Just incredible.
And this quote right here, it gets to the very heart of their strategy. Under their Big and Innovation 2030 plan, the company is aggressively recycling its capital by selling off assets. That alone generated over 34 billion yen in gains this quarter. They are actively, and I'd say brilliantly, engineering their portfolio for value.
Now this brings us to a super important metric you need to know to understand this company: business income. See, unlike standard operating income, this number actually includes the gains from selling properties. So what does that tell us? It tells us their strategy isn't just about passively collecting rent. It's about actively trading and upgrading their portfolio to generate massive profits.
And it's not just the sales side either. On top of those incredible sales numbers, their bread-and-butter leasing business remains incredibly strong. The company's vacancy rate is just 1.1%. That is significantly below the already super tight Tokyo market average, and it really just proves the premium quality of their buildings.
Okay, so with a start this good, you'd think management would be shouting from the rooftops, right? Well, not exactly. Their forward-looking view remained surprisingly conservative, and that created a lot of chatter among investors.
And this leads us to the central puzzle from the earnings call. I mean, think about it. You've already banked nearly half of your entire year's profit target in just 3 months. So the obvious question on every single investor's mind was, why on earth did you not raise your guidance?
Well, the likely answer points to a pretty conservative and maybe very smart approach. Management basically admitted that Q1's outsized 36% margin in property sales probably won't last all year. So by keeping guidance steady, they're building themselves a nice cushion against any uncertainty and seriously de-risking their full-year targets.
Of course, one of those areas of uncertainty is interest rates. You can't talk about real estate without talking about rates. And yeah, the company carries a lot of debt, but a healthy 33% equity ratio puts it in a pretty solid position to manage the gradual policy changes we all expect from the Bank of Japan. It's for sure a key macro factor to watch.
So, let's put it all together. What's our call? How should investors be thinking about this stock right now?
Our thesis here is pretty straightforward. It's bullish. And it's all centered on that proven operational excellence, what we analysts call execution alpha. This isn't just a company riding a market wave. This is a company that is actively creating its own value, and that sets it way apart from the more passive real estate players out there.
So based on that strength, especially their incredible ability to generate value through that active portfolio management, and the fact that their full-year guidance now looks very de-risked, we are assigning an outperform rating.
Now, that rating leads us to a pretty specific trade idea, a pair trade.
The strategy is to go long Mitsui Fudosan while at the same time shorting a J-REIT office ETF. So in simple terms, you're betting that Mitsui Fudosan's skilled management is going to create more value than the passive rent-collecting real estate market as a whole, especially if rising interest rates start to put pressure on the entire sector. The results from this quarter suggest that yes, it absolutely can. And that leaves us with a final thought on the power of great strategy versus macro trends. Mitsui Fudosan is really proving that superior execution can win the day.
To recap, Mitsui Fudosan delivered an exceptionally strong quarter. And as always, please remember, this is not financial advice.